When we record a journal entry, we record it in the currency of the company. So in this example, a US company has purchased merchandise from a British company. The merchandise cost 10,000 British pounds. We need to record that in the US dollar amount, as we're a US company. So the exchange rate on August 1st is $1.63 per British pound. We would record inventory of $16,300 and a payment of cash of $16,300. In this example, we purchased on credit an amount of inventory with the exchange rate of $1.63. However, by the time we paid for this credit purchase, the exchange rate has changed to $1.61. Therefore, we have a gain of $200 on fluctuations in foreign exchange rates. Companies will show their gains and losses on foreign currency transactions in their financial statements on their income statement. This also looks at that same transaction. So, except in this transaction, we're selling merchandise to a British company for 10,000 pounds. The amount is collected in full on that date. So they pay us 10,000 pounds, which is the equivalent of 16,300 US dollars on that date. If they had paid us on credit, we would have recorded the accounts receivable at the exchange rate of the date the sale was made. And then we would record a loss on fluctuations in foreign exchange rates because the value of a US dollar to a US pound had changed by the 2 cents. So when we look at that, we record the initial transaction. So November 10th, Japanese company records a sale and an account receivable of 10,000 yen. On November 10th, the US company records an asset and an account payable of $100,000. On December 31st, we have an adjusting entry of a gain due to foreign exchange rate exchange, our payable of $97,000. So instead of $100,000, it's now a payable of $97,000. Then on January 10th, we would record the cash disbursement of $99,000 and a $2,000 loss on payable and eliminate the payable net gain. Our net gain on the foreign exchange is $1,000. We had the $3,000 gain on December 31st when we made an adjusting entry, and then we had a $2,000 loss when we made the payment from the fluctuation on our exchange. As I said, we would then show our foreign transaction gains and losses on our income statement, on our financial records, on our annual report. So who wins and loses? Usually, they kind of net themselves out. However, US companies that import a lot of foreign products can have large foreign liabilities. And companies that export US products to other countries are likely to have large receivables stated in foreign currencies. And some currencies are historically stronger against the dollar than others. And sometimes we strategically plan on what companies we purchase from based on that kind of strength against the US dollar and not. Strategies to avoid losses from rate fluctuations. So we have some approaches to avoiding losses. One of those is called hedging. The other way is to insist that all transactions have to occur in our own currency so that we don't do foreign exchanges at all. So we can say, if you're going to do business with us and we're a US based company, you always have to do business with us in US dollars. We're not going to deal with foreign currencies. The other way is called hedging. And hedging is when we basically make a bet at the bank about whether or not the currency is going to lose or gain money. So we would purchase a hedge against that foreign currency if we thought it was going to rise or if we thought it was going to go down. So in this example, a US company makes a large credit sales to companies in Mexico. They anticipate that the exchange rate for the Mexican peso is going to decline. So the US company can avoid losses by setting its sales price in dollars. If the exchange rate does change, the Mexican company has to deal with creating more pesos to become dollars. However, the Mexican company would rather work in their own currency, and they don't want to deal with the financial currency translations either. Hedging sits on both sides of the fence. We take offsetting positions so that our gains and losses offset one another. So we buy these future contracts, which is the right to receive a specified quantity of foreign currency at a future date, which means we hedge on what the exchange rate is going to be on the day that we agree to the transaction. Global sourcing. So global sourcing is when we get parts from multiple countries or multiple organizations. If the differences in exchange rates from different companies can create a lot of pricing differences and costing differences between different products. And we're going to look at an example of a product on the next slide. So we have Barbie. We're looking at Mattel Barbie, and we get parts. We have molds in the US, we get hair from Japan, we have oil from Saudi Arabia, we have parts from Taiwan, we bring things over from China, we have train, semi, ships, transactions. So we have all of this example. We have 5 different currencies for the parts that we're transferring our Barbie around. We're getting cost buildup. We have raw materials from Saudi Arabia, Taiwan, Japan, China. We have labor in China. Our management is in Hong Kong. And so as we make transactions between these foreign currencies and the US equivalent, we get a total export cost here of $2. But as these fluctuations to the US equivalent to dollars can change on an almost daily basis, the product costs of our items that are being globally sourced can also change on a daily basis. The last thing that this chapter talks about is the Foreign Corrupt Practices Act. So this is an act that was passed in 1977 originally by the Congress and then has been amended in 1988 and 1998. It describes fines and jail time for any businesses that are violating the rules. One of the basic instructions under it is that US-based businesses are prohibited from bribery. So some countries, bribery is an actual legal part of business. And this Foreign Corrupt Practices Act prohibits US-based organizations in participating in those bribery schemes. So we have to work around with government officials in other ways. So if the US decides to work in countries where it's normal for government officials to be bribed in order to get building permits and stuff, they're not allowed to do that, and they have to find another way to do business in that country. And that is the end of chapter 15. There's not a lot of math or calculations in this chapter. It's just a lot of terminology and a lot of general knowledge about the fact that global business operations create a lot of accounting difficulty, especially when we're talking about product costing, when we are manufacturing with parts and pieces from multiple different countries.